Kraft Heinz is down more than 12% year to date, and we can see it currently trading right there towards its 52-week low, and this is a company that is yielding near 5% with a buy rating from Wall Street. So is it undervalued? Is it a great opportunity for long-term growth as well as that yield over the next year and beyond? We'll also want to understand why is this company down, what is happening with these higher prices, whether or not consumers are still buying these products, and we'll also look towards their dividend safety. Very important, it does sit at a borderline safe score, so whether or not this is something we do need to factor in when we do come onto the valuation. We'll also talk about some insider selling that we have noted over the last few weeks, as well as look at the institutions to see whether or not they're buying over the longer term into their portfolios. And as always, very important when we do look at these type of companies that have been hammered, to understand whether or not their top line revenue continues to grow, as well as their bottom line net income, and also understand the health of this company. We want to see their cash versus their total debt to understand if there is room for that dividend to grow and in fact for that dividend continue to be paid. Now, as always, we will run KHC through the valuation model. We'll get to both our intrinsic value, our acceptable buy price, factoring in our margin of safety, as well as looking at Wall Street and what they forecast over the next 12 months. So let's have a look at their historical performance. Now, yes, down more than 12% year to date. In fact, over the last 12 months, again, a very similar poor performance. And over the last 10 years, as we can see, down 46%. You would need to go quite some way away to see their all-time highs. Their all-time highs, as you can see, you would have to go to around February 2017 at around $100. That is, as you can see, 3 times more than the current trading price. So again, just something to factor. Now let's take a look at the numbers, how well they are progressing. On the top line, we do want to see 3 to 7% growth on a baseline, $11 billion in 2014, $26.6 billion in 2023. So over the last 10 years, they have more than doubled their top line, a very positive sign. But when we do take a look at it on a graphical basis, we see a very large sharp run up until December 2016. From that point, though, we can see their top line has barely moved year on year. And if you were to factor in inflation into this number, you could, in essence, argue that their top line in real terms has been decreasing. When we look at their net income, $657 million reported in 2014, $2.9 billion in 2023, so a large increase as well on their bottom line net income, but again, very inconsistent. In fact, we do see a year of a net loss in 2018, and there is no real trend. It hasn't been increasing over the longer term, and that is something ideally we do want to look at when analyzing these companies. So again, do factor that into your margin of safety if this is one you do want to acquire into the portfolio. In terms of a quick health check, them $2.3 billion cash in 2014, 1.6 in their latest report. So we can see their cash and short-term investments has decreased, and in fact has been decreasing over the longer term. But as always, we never look at that purely in isolation. In reality, it doesn't tell us anything. Hence why we always look at it in combination with that total debt, which we can in fact see has increased $13.4 billion in 2014, $20.6 billion in that latest quarterly report. So we can in fact see that it has been increasing over the longer term, but again, inconsistent. Some years it has increased, some years it hasn't decreased. And in fact, what we do know, 2016, it has been coming down to 2023. Still, that total debt amount is very high in comparison to the cash balance they currently are sitting on. Now, what we like to do is compare it to how they've performed against analyst targets on the earnings per share. What's quite nice to know, over the last 4 quarters, they have in fact either been in line with analyst targets or beaten, so a 100% track record. Moving forwards into the next quarter, they are anticipating negative growth, so negative 5% year on year. Moving on though, they are anticipating mid-single digit increases. So not bad, something just to be aware of. This isn't a company that is increasing their year-on-year earnings per share at a rapid rate, but as you are aware, mid-single digits, and that will take it for 2025 at 3.2 to a forward P of around 10.3, not far off the estimated forward P for December 2024. What we also like to do in our analysis, a few grades, and the first one is the valuation with the underlying metrics. Now, KHC do get a B+. First thing we'll point out is the P on a non-GAAP basis, forward-looking just under 11 as we've previously mentioned. Sector as a median a lot higher at 17.1, so you are getting a discount of around 37%. Just one thing to bear in mind though, with these, just because they are lower than the sector median, it could be that, for example, some of the growth estimations and the profitability are a lot better in the sector. So just do factor that in. Not necessarily when you compare it against the sector, it really means much. That's why the other grades that we also look will shed some light. There are also other valuation methods as well if you do want to incorporate it, but we can see, for example, on a price to book, they are trading at quite a significant discount to essentially the sector median. Now, the next grade that we will take a look at is a growth grade. Now, they get a D-. Year on year, negative 1.36%. Sector median, even though it is still positive, it is low single digit at 2.76%. Forward looking, KHC, very minimal growth at 1%, sector around 3.6%. And the other thing that we like to draw your attention to, which unfortunately doesn't shed this company in great light, is the earnings per share on a forward looking basis. 3.78% over the next 3 to 5 years, year on year, whereas others high single digit at 8.18. Final thing that we do want to point out is their profitability, which is looking at an A in comparison to the sector. Although we do note their gross profit margin, 34%, isn't too far off that of the sector. And when we look at their bottom line, 10.6, that is where it does shed some strength, with 5% being the sector median. So gross profit, not too far off the sector, although the net income significantly better. And what we also want to point out, cash from operations, 4.26 billion, and here we can see the sector a lot lower. So a quick essential conclusion from this part of the analysis: 1 buy rating from Wall Street, a double hold from the other 2 analysts, a B+ on valuation, a D- on growth, with an A on profitability. Now, we were talking earlier about what is going on with this company in terms of the share price. Why has it dropped? Well, they did release their earnings not too long ago, and in fact, as we can see, they did miss against the analyst targets. This is both their revenue, which came in under, as well as their earnings per share. And the major reason that they do talk about this is the sales and volume mix did drop. Reason for this? Well, with inflation, they have been increasing those prices, which they have been trying to pass on to the consumers. But what they are finding out is that consumers who see the increases in their products have been turning away to other cheaper alternatives, whether it's their supermarket-owned brand. So again, something just to bear in mind if this is one that you are looking to consider for the portfolio. And what they also did was reiterate their full year outlook with the adjusted earnings per share to be around 3.01 to 3.07, a 1 to 3% growth from 2023. And as we saw, in terms of the next 3 to 5 years, this is looking likely to be lower than the sector average. Now, what we also want to do, which we didn't cover yet, is compare their performance against others in the packaged food and meats. This will let us know if there are any issues with the industry as a whole, or whether this is something that is isolated to Kraft Heinz. We have Dannon, we have the Hershey, General Mills, Kellanova, Tyson Foods, massive names that I'm sure you would have heard of. Over the last year, well, down 7.31%. As we can see, in fact, 4 of the 6 that we are looking at are pretty much negative. When we expand this over the last 5 years, we do see KHC in the top 3 up 35%. Not the greatest, because bear in mind this is reinvesting those dividends. And over the last 10 years, in fact, they are down. They are the worst performing, with the only company that has been negative. So lots to take in. The major thing I would say is if you truly believe in this company, don't let this past performance put you away, because past performance is not an indicator of future performance. Just something to understand, and just maybe if you want to factor into your own investment thesis, the information is there to do so. Now, what I also like to do, compare it to the S&P 500. Why bother investing in a company if you don't believe it will outperform the S&P, which we can see is up 25% over the last 12 months. KHC down just under 6% negative. Over the last 5 years, 88% versus 37%, and when we expand it over the last 10 years, we can see pretty much at every single point the S&P has outperformed. But again, if you were to have bought it and sold it over a few years, you could have outperformed. But it comes down to one, whether you see this as a value play or whether you see this as a long-term play. And if it is a longer-term play that you are looking for, then just consider whether or not you believe over the longer term it can outperform the S&P 500. So in terms of insider movement, well, 0.37%, we see 2 insiders selling over the last 12 months for around $6.4 million. With the more recent one, as we can see, Q2, 365,000, and we can see that this is effectively an insider selling on the 6th of May. We have the director selling on the 2nd of January of 2024. But with that most recent buy, over 10,000 shares for around $364,000, with the share price higher than what it's currently sitting at. Let me know though if you think this is a bearish signal. For me personally, one, the amount isn't that much, and secondly, the other thing that we always say is that whether or not they sell, we don't know the reasons, and it could be personal reasons, or in fact, it could also be financial reasons. Now, before we look at the institutions, just to let you know, we have released our latest free weekly article. If you want access to this or any other articles, all completely free, click on that pinned comment below where you can sign up. For example, how to find undervalued stocks. We run through the resources and the websites we use on this channel, as well as on our own evaluation. Or if you want to look at 12 undervalued stocks to find high quality companies that do be trading right now at a bit of a discount. So back to the institutional ownership, well, 78%. We see $2 billion worth of sales by the institutions over the last 12 months. We see double the amount of buys as well over the same period. And what we can in fact see here is, well, in the more recent period, a bit of a contradicting evidence. We see more selling by the institutions than buy. That's also applicable to the previous quarter. So yes, over the longer term, over the last 12 months, in fact, notably Q2 of 23, we do see institutions buying more, but in the more recent period in Q1 of 24, we see institutions selling as well as seeing insiders selling that we just saw in Q2 of this year. As always though, do your own due diligence, never copy what they do, but it can always be interesting to look and include in your own analysis. Next thing that we want to point out is their dividend safety score, 60. It does look to be borderline safe. Market cap around 40 billion. It is a large cap company. And we can see, in fact, it was just reaffirmed not too long ago that this suggests a moderate risk of a dividend cut over a full economic cycle. Now, in terms of the last recession, we don't have the dividends, so assuming they hadn't paid, there's no comparative data, but we do see negative 5% recession sales. That was above the average of the S&P at around negative 12. Dividend growth, well, not the greatest. They haven't increased it since 2019. In fact, negative 9% on average over the last 5 years due to a dividend cut, and on average over the last 20 years, 0%. Again, not looking in the most favorable light, as we can see a cut in 2018. Since then, it has remained fairly flat, and they have been paying a dividend for the last 4 years without a reduction. Now, in terms of dividend yield theory, for those that are newer to the channel, it does state the company is undervalued when the current yield sits above the 5-year average. So we do have that one signal here, 4.94 above the 4.46. Just bear in mind, we don't look at any of these models in isolation. We'll conclude towards the end. As well, the forward P, not just below the 5-year average of 13.3, but also significantly lower than the consumer staples sector at 17.7. We then draw your attention to the free cash flow payout, below 70% if we want to be industry specific for consumer staples. Now, it has been a bit of a hit and miss. It has been significantly above that in 2022. What that indicates to us is that management paid out more in dividends than they generated in free cash flow. If you were to look at the earnings, you would not be aware of that, and that is why we tend to ignore the earnings data. It is susceptible to manipulation by management through accounting. What is nice though, 66% in 2023, expected to go lower in 2024 to 54%. So I would like to think that over the next few months, they will look to increase that dividend for the first time in quite some time. Next thing that we draw your attention to is the free cash flow per share. We want consistent increases over the longer term. What we can see, in fact, it has decreased from 2014 to 2023 and been incredibly inconsistent. On a more positive note though, it is up from the 2022 127 and is anticipated to increase into 2024 as well. So a good sign that potentially it is turning around, but also bear in mind the factors like we saw with consumers turning away from the high price increases of Kraft Heinz. In terms of the percentage of the top line, well, we do see pretty poor from 2017 to 2023. That isn't even at that minimum 3% that we want to see just to keep up in line with inflation, and we can see that in another format in terms of their total sales. It has barely moved from 2016. If you incorporate a 3 to 4% inflation year on year, it would in fact be decreasing. Shares outstanding as well, they haven't really done any share buybacks. In fact, what they have done is issued shares over the last 10 years. So again, do bear that in mind. They are diluting your position as a shareholder. In terms of ROIC, now remember, this gives us faith that management are able to effectively allocate their capital. I prefer 10% or more, industry specific 12%. Not only have they not been able to get above that, but it is consistently low at the 6 to 7%. So again, do factor that into your margin of safety when we do come to the valuation piece. In terms of operating margin, well, around 16%. One thing is positive is that it is above that. The other thing we would say, though, it has been decreasing, and with the push of consumers moving away to cheaper alternatives, they may have to start lowering their margins so they can bring back customers to those products. So again, do factor that in. And the free cash flow margin above 7%, very inconsistent, but they have been there or thereabouts over the last 6 years. 12% on a trailing 12-month basis is also positive. Now, finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, below 4 for consumer staples, number of years to pay essentially all of their debt net of cash on hand. And why this is important that we always look at it, well, it correlates to balance sheet strength as well as dividend safety. And what we can see, 2.7 in 2023, 2.58 in the next year. So it is coming down and is below that 4. So this in combination with the free cash flow payout lowering, the dividend does look safe. And I would like to think at some point soon they will start to increase those dividends. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, well, Graham's valuation formula. We have the stock ticker symbol, the earnings per share, growth rate, and the yield on AAA corporate bonds, giving us an intrinsic value. Now we have an overvaluation side of basically around 10%. Just bear in mind though, we're not looking at any of these models in singularity. We then have the multiples valuation model, companies in a similar sector and size that we analyzed earlier. Their average P multiplied by that of KHC to get an intrinsic value here showing some significant undervaluation, essentially confirming what we discussed earlier, that this company is trading significantly lower than the sector as a whole. We then move on to the dividend discount model. Now they haven't grown that dividend in quite some time, and what we have gone for forward looking, as we are estimating over a longer period, we have gone for around 3%. Now normally we would like to go for 4%, but we want to be more conservative today, and this gives us an intrinsic value pretty much whilst we see an undervaluation signal. It isn't too far off that current value. So on the DDM, we would argue here reasonable valuation. We then have the discounted cash flow model, the free cash flow year on year. Average growth rate, negative 24%. A lot of skewed data given it has gone from positive to negative at some points here as well. Forward looking, we've gone much lower than analyst targets of around 6 to 8%. So with our 5% and our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see here significant undervaluation. Now we get to the intrinsic value in today's episode, which is the average of these 4 models, and it is coming to $37.50. Do bear in mind though, you can grab a copy of this model by clicking on the pinned comment below, running in your own numbers to get to the intrinsic value, as well as your own acceptable buy price, whether it's for KHC or others in your portfolio and watch list. So margin of safety, as always, we start off with 10%, execute on that if it has a wide moat, strong financial metrics, good forward-looking data. If you believe that for KHC, well, it is effectively a buy at around 33.75. If you believe that you need a larger MOS, well, at 15%, it is pretty much around that current trading price, around 12 cents shy. And that is what we do see in today's episode based on the estimates and judgments we just ran through. For those looking for a 20%, you would need to wait around $30. So right now then, as we said, 15% margin of safety. Personally, for me, this isn't enough of a margin of safety to consider. We also have the issue where they haven't increased their dividend in quite some time. In fact, they have cut their dividend in the more recent period. They haven't increased their top line, which for me is a massive red flag indicator. And with the fact that even forward looking, they're anticipating earnings per share to be low single digit, there are a lot of red flags right across this company. Now, yes, their yield is fairly nice at 5%, but if they're not increasing it every year, then as we always incorporate inflation, it will be decreasing. In terms of Wall Street and their forecast, well, actually, they see upside of 24%. They have a price forecast of just under $40 above our intrinsic value, so they do consider this a buy, as we did state at the beginning of this episode. As always, though, do let us know your thoughts in the comments below. Maybe this is a company for you. Let us know why in the comments. Maybe this isn't one for you, and you should also let us know. And for those that have it on the watch list as well, let us know what price you are looking at. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.